All right, so tech stocks, huh? They've been they've been taking a bit of a beating lately, haven't they? Well, with all this back and forth on tariffs and how everyone else is, well, reacting to that. And it's got a lot of folks wondering if this is, if this is the dip to buy.
Yeah, it's the question on everyone's mind, isn't it? And that's exactly what we're gonna dig into today, trying to make sense of it all. You've been going through expert opinions, looking at the market as it stands, and what we're here to do is help you sift through all of that to give you a clearer picture of what the potential upsides could be, but just as important, what the potential downsides could be too. And we want to do it all without getting too bogged down in all the jargon.
Right, exactly. So maybe we should begin by looking at where these opportunities, these potential opportunities, might be hiding. I mean, it does seem like this sell-off, it's made some really solid companies, some real heavy hitters look, well, surprisingly cheap.
Yeah. No, you're spot on. When you look at the data you've pulled together, it does point to some pretty attractive valuations, especially in certain corners of the tech world. Take Microsoft, for instance. It's down about 19%, right? And its price to earnings ratio, it's sitting at like 30.2. Now, what's interesting here, what you got to keep in mind, is that its average PE ratio over the past like 10 years, that's been significantly higher, around 33.2. So this difference, this could mean there's a real opportunity here, potential discount, compared to how it's been valued historically.
And it's not just Microsoft feeling the heat. I mean, Amazon stock, that's taken a pretty big hit as well, hasn't it?
Absolutely. Amazon, its stock's down about 25%. And now its PE ratio, it's hovering around 32. You put that in context, you look at the bigger picture, and that's the lowest it's been since 2009. Think about that. That's post-financial crisis territory. For a company that's been such a powerhouse for growth for such a long time, it does make you stop and think. It raises some really interesting questions about whether it's undervalued right now, given its potential.
And then there's ARM Holdings now. They've had an even steeper fall, down a whopping 44%. But from what we've seen, there's a particular reason why you might want to take note of this one.
Yeah, there is. What's really fascinating about ARM is their role in AI-driven data center CPUs. They're right in the thick of it. And analysts, the folks who follow this company closely, they seem pretty bullish. Their forecasts, they're suggesting a possible upside of like 77%. It might be that all the broader market worries, all the noise, it's kind of overshadowed what ARM has going for it. Those specific growth drivers, in a sector that's just exploding and really, really strategically important.
Right. And then there's a company that might not be as familiar to some folks, DigitalOcean. They're showing some pretty interesting numbers as well.
Yeah, DigitalOcean. They're in the cloud computing space, right? They primarily work with smaller businesses, medium-sized businesses, and right now they're trading at a pretty substantial discount. We're talking like 29% lower when you compare their current price to sales ratio to their historical average. But here's what's really catching people's attention. Their revenue, specifically the part driven by AI, that's skyrocketed. I mean, we're talking a 160% increase year over year. It's a good reminder that this whole AI revolution, it's not just a story for the big tech giants. It's really driving some serious growth in more niche parts of the market too.
So what we're seeing here is that if you're thinking long term, especially in areas like AI, cloud computing, these lower prices, these could be some pretty attractive entry points, wouldn't you say?
Yeah. That's the takeaway from this first batch of data. If you're an investor and you've got that long-term mindset, if you're focused on these key growth areas, AI, cloud infrastructure, the whole ongoing digital transformation, well, this downturn, it's seemingly created some pretty interesting opportunities that are worth a closer look for sure.
Okay. So these potential discounts, they sound tempting. But the information we've been looking at, it also includes some pretty stark warnings about the risks of trying to time the market perfectly. Why is that such a dangerous game to play?
Well, because it brings up a fundamental challenge with investing. Even when certain stocks look undervalued, how can you be absolutely certain that they won't drop even further? The data you shared, it highlights the very real risk of trying to pinpoint the absolute bottom of a market decline. And we saw a perfect example of this just recently. There were some retail investors who decided to buy in during a 3% drop in the S&P 500. And just to clarify for folks who might not be, as familiar with that, the S&P 500, that's a broad index. It tracks the performance of like 500 of the largest publicly traded companies in the US. So they bought in during this 3% drop, right? It was a Thursday. And then what happened? The very next day, even more losses. It just goes to show how quickly things can change, how fickle market sentiment can be, and it really highlights the inherent risk of trying to make those kinds of short-term predictions.
Yeah, it's like trying to catch a falling knife, right? You never know when you're going to get cut. And one strategy that often comes up as a way to kind of navigate this uncertainty, this is dollar cost averaging. Can you walk us through how that works and why it might be a useful tool, especially right now?
Absolutely. Dollar cost averaging, it's all about consistency. You basically invest a set amount of money at regular intervals, like clockwork. Let's say you decide to put in $100 every month. You do that regardless of what the price of the asset is at that moment. It doesn't matter if it's up or down. You stick to the plan. And what this does is it helps you average out your purchase price over time. So when prices are low, your fixed investment, that $100, that buys you more shares. And when prices are high, well, it buys you fewer shares. This helps reduce the risk of going all in, investing a big chunk of money right before the market takes a nosedive. It's a way to still participate in those potential gains, but you're also mitigating some of that downside risk, some of the volatility.
And it seems like just blindly throwing money into broad tech ETFs. ETFs, for those who aren't as familiar, those are exchange-traded funds. They track a bunch of different tech stocks. But it seems like that might not be the smartest move right now either. And Morgan Stanley, they had some interesting thoughts on this.
They did. Morgan Stanley is basically saying, look, you got to be a little more discerning in this environment. You can't just go with the flow. They're warning against passively investing in what they call old leader tech ETFs.
Yep.
That suggests that the big tech rally we've seen in the past that might not necessarily continue in the same way. They're emphasizing the importance of actually picking stocks, doing your research, really understanding the companies, identifying those that have the strongest fundamentals, the most promising growth prospects.
Yeah.
It's not just about betting on the sector as a whole. It's about being much more selective.
Yeah, it's about being smarter with your money, right? Not just saying, "Oh, tech's down, let's buy tech." Okay, so let's zoom out for a minute. Let's look at the bigger picture here. These tariff worries, they're not happening in a vacuum. There are these broader economic forces at play, forces that are contributing to this whole sense of unease, this uncertainty in the market.
You're absolutely right. This tariff-driven sell-off, it's really just a symptom of these much broader macroeconomic anxieties. The biggest one, the one that's really front and center, is the fear of a trade war. When you have major economies like China, when they start slapping on retaliatory tariffs like that 34% tax they put on U.S. goods, well, that creates this ripple effect. It disrupts those global supply chains, and a lot of tech companies they operate internationally, right? They rely on these complex networks of suppliers and global markets to get their products out there. These tariffs, they can directly impact their costs. They can potentially reduce demand for their products in certain regions, and that ultimately filters down to their bottom line, their earnings.
And even beyond the immediate impact of these tariffs, there's the whole question of the market's overall valuation.
Right.
That's something you got to keep in mind.
Yeah, that's critical. Even after all the recent drops, the S&P 500's forward PE ratio, and that's basically an estimate of future earnings, that's still sitting above its long-term average. It's around 20.6 right now, which is higher than the 10-year median of 18.1. What this means for you is that even with some stocks looking cheaper, there's still a chance that we could see further adjustments, further corrections across the whole market.
Yeah.
Especially if companies don't meet those earnings expectations. The market, it might still be, trying to find its footing, trying to adjust to this evolving economic outlook.
And then you've got interest rates. We know that the Federal Reserve, they've signaled that they're planning to cut rates sometime in 2025. But until then, it's still a bit of a wild card, isn't it? How does that factor into all of this?
Yeah, it does. It does add another layer of complexity to the mix. Typically, when you have the Fed signaling rate cuts, that's generally seen as a positive thing for growth stocks, for companies in sectors like tech. Lower rates, they make it cheaper to borrow money, and that can stimulate investment. But there's this looming concern, this specter of stagflation that could throw a wrench in the works. Stagflation, that's a nasty combination of slow economic growth and high inflation. And in that kind of environment, even lower interest rates, they might not be enough to really prop up those high valuations, especially for tech companies whose future growth prospects start to look a little shaky.
So there are some pretty significant headwinds out there, some real uncertainties that you need to be aware of. But the long-term story for tech, that still seems to have some pretty powerful drivers, doesn't it? It's not all doom and gloom.
Yeah. No, it's not. It's important to keep that in mind. Despite all the current market turbulence, the fundamental strengths of the tech sector, they haven't gone away. The rapid expansion of artificial intelligence, I mean, that's a prime example. We're seeing incredible growth in that area. Companies like Microsoft, they're reporting just massive year-over-year revenue growth in their Azure AI division. We're talking like 157%. And Amazon's AWS, they're investing heavily to become a leader in AI infrastructure. They're focusing on developing those more cost-effective chips, those foundational AI models. This shows us that the demand for AI capabilities, it's not going anywhere. It's only getting stronger, and it's cutting across all kinds of industries.
And this shift towards cloud computing, this is still a major growth engine as well, isn't it?
Oh, absolutely. The demand for cloud-based services, it's not slowing down, even in those more specialized segments of the market, like what DigitalOcean's doing with those small and medium-sized businesses. We're seeing that AI adoption, it's driving some really substantial increases in recurring revenue. The scalability, the flexibility that cloud computing offers, I mean, that's still a huge draw for businesses of all sizes, and that's driving continued investment in that area.
And if you look a little further down the road, there are projections for stronger earnings growth across the entire stock market in the coming year. How could that impact the tech sector? And how should you be thinking about that in terms of your investment decisions?
That's another potential positive to factor in. Analysts are projecting earnings growth of like 13% for the S&P 500 in 2025, and that could provide a more solid foundation for tech valuations as they stand now. If companies across different sectors, including tech, if they can actually deliver on those earnings expectations, well, that could help to ease some of the anxiety around those current price to earnings ratios and potentially lead to a more stable market overall.
Okay, so we've got a lot to think about here. We've got these potential bargains, but then we've also got the risks of trying to time the market. We've got this macroeconomic backdrop that's pretty complex, and then we've got these long-term growth drivers. Given all of that, what are some of the strategic recommendations that are coming out of all of this? What should you be doing as you're trying to navigate these choppy waters?
Well, the analysis really points to a few key principles to guide your investment strategy. First and foremost, you've got to focus on the fundamentals. Now's the time to really roll up your sleeves and dig into those individual companies. Look for the ones that have strong, consistent cash flow, manageable levels of debt, and significant exposure to those key growth areas we've been talking about. AI, cloud computing, Microsoft and Amazon are two examples that are specifically mentioned as established players that fit this bill.
Right. Stick with quality. Got it. What else should you be thinking about?
Geographic diversification. That's another important factor with all the uncertainty around global trade, the potential for the dollar to weaken. It's probably wise to look beyond just U.S. stocks. Think about allocating a portion of your portfolio to non-U.S. markets. That can act as a hedge against some of those domestic risks, both economic and political.
And are there any particular areas, any types of investments that you should be extra careful about right now?
Yeah, the advice is to be wary of those those highly speculative investments, the ones that are really leveraged, those meme stocks that tend to pop up, they often fall into this category. And be cautious of companies that are showing signs of slowing revenue growth, even if they are improving their margins, like Block, for instance. They've seen their stock price drop significantly this year, even though their margins have gotten better. It's a reminder that a slowdown in top line growth that can still have a big impact on a company's valuation.
So bringing this all together, the question of whether it's a good time to buy the dip in tech stocks, that's not an easy yes or no answer, is it? Yeah. It's a lot more nuanced to that. There's potential for rewards, but there are some serious risks as well.
That's a very accurate way to put it. The overall picture that emerges from the analysis, it's a high risk, high reward scenario. While those lower valuations of some of the big tech companies like Microsoft, Amazon, they could be good entry points for long-term investors. You got to remember those macroeconomic uncertainties and the fact that timing the market perfectly is incredibly difficult. So a measured, cautious approach, that's definitely the way to go.
So if we were to boil this all down, what would you say is the most important takeaway for you, the listener, as you're weighing all of this?
The most sensible approach, based on what we've seen, it seems to be to have a disciplined long-term strategy. Rather than trying to get rich quick by calling the bottom of the market perfectly, a more reasonable path would be to use dollar cost averaging, that steady, regular investment approach, and combine that with a careful, selective approach to picking your stocks. Just like Morgan Stanley suggests, it's about building a strong, diversified portfolio over time, rather than trying to make one big bet, one perfect bet.
Okay, that's really helpful. That gives you a good framework to think about all of this. So as we wrap up this deep dive, here's a final thought for you to ponder. Yeah. Given how quickly AI is advancing and all the complexities of geopolitics, of global economics, how do you think our understanding of what a safe, reliable, long-term tech investment is, how will that change in the years to come?
If you found this discussion informative, please like, subscribe, and share this channel to get daily discussions on a current economic topic.